Welcome to HDTV. You're now rocking with your boy. My bad, y'all, man. I had a little too much coffee. Oh, man. Exxon faces $20 billion hit from epic failure of a decade ago. ExxonMobil's nightmares 2020 just got worse. The embattled energy company announced Monday that it would dramatically mark down the value of its natural gas properties. Exxon also promised to sharply scale back its spending ambitions as it braces for a more muted oil price recovery. Exxon, parentheses XOM, plans to take a non-cash charge of $17 billion to $20 billion, a massive hit for a company that was long opposed to take write-downs. It's believed to be the largest such write-down in Exxon history. It acquired natural gas giant XTO Energy for $41 billion in late 2009. Roughly half of that deal's value has now been erased. The natural gas market is depressed, with gas trading at about $3 per million British thermal units, less than half the price at the time Exxon swooped in to buy XTO. Natural gas peaked in late 2005 at more than $15 per million BTU. But today the world has a glut of a natural gas due to the shale boom that unlocked vast amounts of fossil fuels in the United States. Exxon's colossal gas asset impairment is management's clearest acknowledgement to date that the XTO deal was an epic failure. Not that any reminders of this are needed. Raymond James analyst Pavel Molchanov wrote in a note to clients Tuesday. The bulk of the write-down covers properties in Appalachia, the Rockies, Texas, Oklahoma, Louisiana, and Arkansas. That were acquired in the XTO deal. The rest of the charge is for overseas gas properties in Western Canada and Argentina. Exxon is hardly the only oil company forced to whittle down the value of its fossil fuel properties. Over the past year, Chevron, parentheses CVX, BP, parentheses BP, and Shell, parentheses RDSA, have all taken massive write-downs. But not only is Exxon slashing the value of its natural gas portfolio, the company has completely removed some of these gas properties from its development plan. Exxon said in a statement that it may sell some of these assets, contingent on buyer valuations. Shrinking the budget. Instead of plowing more money into natural gas, Exxon is promising investors it will prioritize near-term capital spending on advantage assets with the highest potential future value. Specifically, not pacifically, specifically, Exxon said it will focus on developing its vast oil resources in Guyana, accelerating production in the Permian Basin of West Texas, and some exploration in Brazil. Not Brazil, Brazil. Exxon is also retreating from its bold plans to ramp up investment despite weak prices. The company now expects to spend $19 billion or less in 2021 and between $20 billion and $25 billion a year through 2025. That's a far cry from Exxon's March projection that it would spend $30 billion to $35 billion a year through 2025. Exxon is scrambling to cut costs and jobs. The company reiterated that it plans to shrink its global workforce by 14,000 or 15% by the end of the next year. That includes cutting about 1,900 jobs in the United States, mostly at its Houston headquarters. The pandemic and crash in oil prices has exposed Exxon's weakened financial state. The company posted quarterly losses for the first time in decades, and it got kicked out of the Dow Jones Industrial Average after 92 years in that index. As recently as 2012, Exxon was the world's most valuable company, but today it is valued at just $161 billion, smaller than T-Mobile US, which parentheses is TMUS, AbbVie, the abbreviation is ABBV, Nike, parentheses NKE, or Adobe, which is ADBE. Exxon's market valuation has crumbled by more than half to a staggering $285 billion since peaking at $446 billion in mid-2014. Precarious position. Wall Street is hoping the belt tightening and a more conservative budget will be enough to save Exxon's dividend, which is critical to its appeal to investors, but analysts are skeptical. This year marks the first time since 1982 that Exxon failed to increase its dividend. Molchanov, the Raymond James analyst, warns that Exxon cannot fund its dividend in 2021 without additional borrowing or asset sales. For now, the capital markets are wide open and Exxon should be able to borrow to fund the dividend, but that can't last forever. It's a question of how much debt they want to take on, said RBC Capital Markets analyst Biraj Borkhataria. The dividend looks challenged, and even if Exxon avoids a dividend reduction, its sharp spending cuts raise questions about the company's long-term future. Oil companies need to continually plow money into drilling. Otherwise, production dries up, hurting cash flows. The company is in a precarious position because of the deals they've done and the fact they've underspent for many years, said Borkhataria. They have to execute on their existing projects to protect the long-term viability of the business. Man, this is sad news for Exxon. I think my uncle, I think that was either Exxon or Shell. I got to talk to him about some of these stuff that's going on. I'll probably be able to put him on an interview about it later and learn some business things. But here's the report in real time. Hold on. They always have these ads. Give me a second, y'all. I'm gonna let you hear it from their mouth, from the word, and I'll give you my take afterwards.
The beating heart of U.S. shale production. In this part of America, they know all too well what boom and bust feels like. Oil service company CEO Bobby Bounds was all smiles during the boom. He and a dozen employees did industrial painting on storage tanks, pipes, valves, anything related to oil and gas in the giant Permian Basin. Then COVID-19 hit, striking first on Wall Street, and in no time, Main Street Midland felt the pain.
So I woke up, I think it was on a Monday, and the Dow Jones had dropped 2,300 or something. And it wasn't 12 hours later, I'm getting phone calls from my big customers telling me to stop all work.
An oil price war then broke out between Saudi Arabia and Russia, and prices went below zero for the first time in history. And so too did Bobby's business. All told, he lost $500,000 of work.
I'm the entrepreneur risk taker. I put resources at risk in hopes of a gain. And if I get some gain, but then it goes bad, well, that's bad for me. But I see it's almost a gamble.
And in this high-stakes game of oil, he was forced to fold his hand, pack his bags for New Mexico, where he started a new business. The economic fate of the Permian, 414 locally. Today, as of early September, the economic fate of the Permian is closely linked to what's called the active oil rig count. Last autumn, when I was on the ground in Midland, it was listed on a...
Well, that's bad for me.
He was forced to fold his hand, pack his bags for New Mexico, where he started a new business. The economic fate of the Permian is closely linked to what's called the active oil rig count. Last autumn, when I was on the ground in Midland, it was listed on a sign downtown. 860 nationally, 414 locally. Today, as of early September, it's 256 nationwide and only 125 in the Permian. Even the big boys feel the pain. As an independent player, Pioneer Natural Resources sits on the region's largest shale assets.
The world doesn't need a million barrels a day of growth coming from the U.S. We'll have to adjust our staffing levels down to right size it to our activity levels. And so we're still in the middle of that process right now.
That's reflected in the local unemployment rate, rising nearly fivefold in a year from just over 2% to 9.4%. Next door in Odessa, it's the highest in Texas. Other oil producers and service companies did not survive. With 3 downturns in 5 years, 492 of them have gone bankrupt, with debt of nearly $300 billion. How do you batten down the hatches and for what length of time?
It's really unknown at this point. It's really dependent on when we get a vaccine and see what happens to demand. So I would say, kind of the earliest is second half 21, but it could roll into 22, 23 time period where we really see demand for oil get back over 100 million barrels a day.
Meaning the shale shakeout for players big and small is far from over.
Yeah, so basically, I wanted you to hear from their mouth and everything, and that was reported by CNN Business. Basically, them losing this money is very detrimental to the company, but a lot of things has happened. You got to think about it. COVID, um, and that hitting, and then now we got the vaccine coming out, which I really don't fully trust. I just think they're rushing it out there because they have to get business back together, and business needs to be flowing in. But to me, gas, they're trying to go towards more natural gas than going towards like what is natural? All of it natural gas. Well, to the oil and everything. But to me, the oil industry and all of that stuff is dying out as well because now people are trying to go solar energy and do this stuff. And not saying that it's not a lot of money still in that, but it's falling a lot because of the COVID. And it's not just this; it's businesses all over. Everyone's business is affected from this pandemic that's going on. And to me, it comes down to Trump at the end of the day. If Trump would have kept the right advisors in office, they would have been able to handle this. They'd have been a front and ahead of this pandemic coming, and we would have still been hit by it, but we would have not been at this point where businesses are losing money and things are closing down and over thousands of people are dying and stuff. So we got to think, man. So to me, that them losing this money really hurts. And Exxon, like I said, this is gonna hurt. And then what I feel sorry for is the people losing their jobs, man. You got to think about it. Exxon is a great business, and people get compensated well. But with this hitting, man, it really hurts because they're expecting their debt is in like the hundreds of billions. So it's not going to recover like the man was saying in the video until like the end of 2021 going into I don't even think it's going to make it in 2021. I think they're going to get hit with more debt. I think a lot more businesses are going to close. And I believe in 2022 and 23, maybe 24, we might get back right. But it's not going to be the same because the business and the market is shifted. Now everything is technology driven. So go figure, man. And to me, that was the dumbest thing to do. Make everything technology driven, man. Like, I don't know why you guys don't understand, like, technology and you're trying to make it this big business. That's not a lot of jobs. People are going to have to start opening their own technology business, their own business, and being their own entrepreneur. But it's hard to do that now because a lot of people don't have money, and then you have to sell you have to sell yours for the retail price, while corporations like Walmart and Amazon and them, they can lower their price whenever they want because they got enough money to cover the losses. So like I said, I don't know, man, but to me this is sad that people have to lose their jobs, and it's been rough on everybody. But thank you for listening. Like, comment, subscribe, share this. Hit the notification bell to select all to receive upcoming notifications. And if you want to donate to the page, you can cash at me at the word welcome, the number 2, and then HDIITV. Thank you for listening, man. And we are out. La boy. La boy.